How does a financial crisis, which in principle only concerns banks and the financial sector, end up spreading to the entire economy? In 3 minutes, you'll know all. Or at least, you'll know more. To better understand, let's take a bank, but a minuscule one. Because it's minuscule, it only has 10 customers, of which 6 are private individuals, 3 are companies, and the last is the state. A minuscule state called Nanonesia, famous for its ukuleles and dwarf palms. But let's return to our miniature bank and consider its minuscule balance sheet. On the right, we can see the liabilities, showing the bank's resources, i.e. its own funds, deposits by its customers, and loans granted by other banks. On the other side are the assets. In other words, what the bank does with its resources. In short, it lends them out to private individuals, companies, other banks, etc. It also lends to this special customer, the Republic of Nanonesia, whose booming economy attracts capital from the whole world over. But let's go back to that balance sheet. The bank pays interest on the sums it has borrowed, so its liabilities cost it money. Luckily, its assets bring in money. And since the bank is run efficiently, the assets bring in more than the cost of the liabilities. The balance is therefore positive. That's how the bank manages to pay its employees and make a profit. So everything is for the best in the best of minuscule worlds when suddenly, crash. In Nanonesia, General Iota has just grabbed power and is threatening to halt repayment of the country's public debt. Nothing is official yet, but the risk is enough to ensure that from one day to the next, no one wants to lend to Nanonesia. Among our bank's assets, those concerning Nanonesia are now worth virtually nothing. So much so that the balance sheet of our mini-bank slides into the red and there is talk of bankruptcy. Now, customers are worried about their savings and start withdrawing their deposits on a massive scale, which is exactly the way that bankruptcy occurs. And this is when the terrible domino effect comes into play. Let's quickly enter the mind of an investor. If Bank X is going bust, he tells himself, so Bank Y will not recover the $7 billion which it lent to Bank X last year. So Y is virtually bankrupt in turn. And if Y goes down, it won't be able to repay Z, and so on and so forth. This causes a chain reaction, resulting in no one trusting anyone else. Banks stop lending to each other. And worse still, they're short of cash, so they also avoid lending to private individuals and companies. Companies that have no more access to credit and are expecting orders to decline, cut back on production and start laying people off. This is how the banking crisis becomes an economic crisis. Moreover, the new unemployed are also consumers who will now consume less. And those in work are worried about the future, so they prefer to save rather than consume, meaning that demand plummets. For instance, large numbers of tourists cancel their holidays to Nanonesia and head for the Alps instead. Nanonesia has not yet officially defaulted, but the mere possibility has provoked a loss of confidence, causing the financial system to seize up. And this situation has triggered a general crisis, with a collapse in economic activity, employment, and demand. In short, the virtual has become real. Real jobs are lost, and real people find themselves destitute. It is because the financial sphere is connected to the real economy that its crises can become a problem for everybody. To avoid this kind of catastrophic scenario, central banks can lend to banks in difficulty. They also require them to comply with certain rules of good practice. But rules do not eliminate risk entirely. Oh well, what do you know? General Iota has finally decided to repay his debts. But it's too late. The crisis has taken root, and no one is listening.